Coming up today, stocks drop ahead of economic data. Economists skeptical of China's new stimulus. China fires a ballistic missile into the Pacific Ocean. Mark Zuckerberg gets a new haircut. NATO prepares for World War III. And what now for China? It's Wednesday, guys. Let's go. And there's the stock market continuing to hold ground just below all-time highs. Calling up again on low volatility. We actually got Jay Powell set to speak tomorrow morning, 10 minutes before market open, with a bunch of other Fed speakers as well. I'm expecting to hear more dovish commentary out of them. Very supportive of the market. But for the here and now, we've got a little bit of a pullback up the front. We can see that with spots of red, with it still being led by defensives. With all indices finishing down today, led by small caps. Russell 2000 down 1.5%. It's actually mega cap tech. As a group finishing the day higher, however, we are getting some reversal signals of mine here on the chart, looking a little stretched in the short term. Pretty much same deal on the Nasdaq index, the Qs. And just for your reference, I've just changed the days in my seasonality forecast indicator. And keep in mind, these are trading days. So 5 trading days is 1 week. Then I've got 2 weeks. The average month has about 21 trading days. So that's 1 month, 2 month, and 3 month. And this indicator is looking by default at the last 5 years, the exact same calendar period going forward, how each asset has performed. So when I scroll through charts, you can see the seasonality forecast for each asset. For example, here, TLT, looking back over the last 5 years, on average, the next 5 days and 10 days, 2 weeks at this period of time, and also the next month, on average, TLT has fallen. And there's a look at gold as well, also looking a little technically overbought in the short term. Got my reversal signals indicator firing off 5 in a row. That's the most we can get in a row, and a little bit of bearish seasonality for the next week or two. And stick with me today, because as usual, we'll get into commodities and oil, and we're hearing news that NATO may be preparing for mass casualties in a World War III scenario. We'll take a look at that and a few other things I'm sure are going to be of interest to you. But first, let's just continue on from yesterday's big story. Massive stimulus coming out of China, looking to get underneath their economy and markets. And after yesterday's explosive move, we had a little bit of a pullback today. Key Chinese indices and ETFs trading down near the lows from yesterday. Now, was this a complete fake out? Or could it be what I call, this is a signal candle, the market tipping its hand to us, and then we're just getting a few entry candles here, where the market can pull back on low volatility and potentially set up for a good entry. Well, first, just a quick recap of what happened. There were big monetary measures by the People's Bank of China. That's their central bank. And you can kind of think of it as like quantitative easing. And this package is worth currently between 142 and 284 billion US dollars. They're cutting banks' reserve requirements. That's how much capital banks have to keep on hand. In other words, helping them to lend more, loosening up credit, lowering a key short-term interest rate, and a real interesting one I found, making loans to shore up the stock market, including 71 billion to help market players buy shares and nearly 43 billion to fund corporate share buybacks. In addition, offering relief for home buyers, lowering rates on existing mortgages, and lower minimum deposits on second homes. So trying to stimulate not only the banking system, the stock market directly, but also the property market. And more importantly, they've indicated they'll go again if they have to. They'll go bigger. This is not their all in. This is a big significant measure from the central bank. However, this is not coming from their federal government directly, in which they could still come out with a monster package around the corner as well. They've still got plenty more ammo they can fire. And so like I said, we had a big shift in financial markets yesterday. Massive volumes. Institutional money appears to have started coming back into China, or at least covering their shorts. And we saw that with the Chinese yuan surging to a 16-month high. And so the yuan trades a bit different from all other currencies, in which they're free market floating. Market forces, supply and demand, determine them. Chinese yuan is more fixed, and they allow it to kind of trade within a 2% daily range, and what's called a managed float system. And they can intervene and have a lot more control over their currency's valuation. And so it is still affected by market forces. And there's a look at the Chinese yuan versus the US dollar. And similar to pretty much every other major currency in the world, since mid-July, the US dollar has weakened a lot against other currencies. And so this could be a sign of foreign capital coming back into China, because when foreign capital goes into a country, naturally has to buy the local currency, and that drives up the price of a currency. Also helped Aussie miners catch a bid on big volume as well. Australia pretty much digs up its backyard and sells it to China, which has helped to drive a lot of wealth creation down under. And so the better China does, the better Australia does, and investors are betting on that as well. There's a look at BHP as traded on the local Aussie exchange, the ASX. Ripping up yesterday on massive volume as the world's largest miner. Not too far behind Rio Tinto, world's largest iron ore miner. And my favourite, Fortescue, looking really good as well. Another large iron ore miner with ambitions to dominate the green hydrogen industry. It could be a key energy source in the future. However, not everybody is optimistic. In fact, I would still say the overall sentiment looking across financial media, social media, and everywhere else I look is still quite bearish and pessimistic, and with good reason. For sure, China's still full of risk. Plenty of people saying their new stimulus bazooka isn't enough to fix the nation's housing crisis. Property has been in a free fall over there that haven't really bounced back after COVID. Plenty of economists still skeptical about China's rate cuts, whether it's going to work or not. But I see it in two ways. A, it's going to work, which is going to help propel Chinese shares higher. Or B, it's not going to work, and then they're going to pull out the big gun. Then you're going to see a big package straight from the CCP, and they'll fire as big as they have to. They're not going to risk social instability in their country. That's their number one agenda. And the biggest part of social stability is economic stability. They want full employment and common prosperity. There's one of Xi Jinping's top items on his agenda. And this is kind of what causes the premium when you see beaten down sectors. Everybody gives up on it, and you get plenty of articles still like this today. China putting a band-aid on its economy. It's missing the real problems. Saying that the collapsing property market is the primary issue, but the People's Bank of China are missing that, and the consumer's still weak, along with foreign capital. Another one in the Financial Times, China's stimulus is hefty but insufficient. They also arguing this latest measure doesn't go far enough, and then much more work is needed to be done. However, just like the 5th of August, maximum fear often correlates with maximum return. And just looking at forward returns for the MSCI Chinese stock index, looking at Bank of America's China risk love level, and when that hits panic, which it did in early August as well. Looking back in history, 12 months out, we're up on average 24%. Year and a half out, we're up on average 35%. The last time that happened, July last year, still down a little bit 12 months later. However, Chinese shares are very volatile. When they rip like crazy. And looking at short interest in FXI, Chinese large cap ETF, that is near all-time highs. The last few times that happened, the market actually rallied. And you'll find that can quite often happen in market. When too many people are leaning to one side of the ship, things can often go hard the other way. Because if you think about it, the maximum amount of profit is possible when the maximum amount of people are wrong. And when positioning gets too crowded, then typically contrarian bets can pay off. And it's not just positioning that's super low. We can see here with mutual funds in the first percentile of China allocations. Hedge funds, the 4th percentile. Also got the forward PE, now almost 2 standard deviations below average. Both equity multiples and investor positioning are at or close to cycle lows. And so there's a look at the weekly chart of FXI. See, it peaked out in 2021. Been in a 3.5-year bear market. Pretty much the only major international stock market to be in a bear market that long. Strong signs of double bottom accumulation, along with this big momentum thrust on volume. And so to my eye, that's really bullish technical signals. However, people are convinced what's happening on the ground now is going to stay that way for quite some time yet, and Chinese shares are still a short here. Also interesting today, at the same time China just went big with a stimulus measure, they also did a rare ICBM test into the Pacific, in which some are saying they're doing that to show might, with them launching an intercontinental ballistic missile into the Pacific Ocean in what appeared to be its first such public test in some 4 decades. A move likely to rattle the US as it seeks to sway world leaders at a meeting of the United Nations General Assembly. And so it appears they're trying to step up on the international stage here and show some teeth, both economically and militarily, in potentially a pretty bold and provocative statement, putting the world on notice. And that to me is the biggest risk of investing in China, is if they invade Taiwan, there is the risk of what happened to Russia in international capital markets could happen to China. We actually saw Russian ETFs delisted from New York. The flow of Western capital pretty much fell off a cliff overnight to Russia. Few investors had to take it on the chin. So for sure, that's definitely possible in China. Or at least there will be a big sell event and correction if we wake up morning to news China's gone into Taiwan, but that won't just be affecting Chinese shares, that'll also be affecting American technology companies who still heavily rely on Taiwan. China wanted to, they can enact huge leverage over American tech. Nvidia, Apple, you name it. A lot of their chips are still made in Taiwan. But this is something that could happen next week. It's also something that could happen in 5 years from now. No one knows exactly when they're going to go into Taiwan. However, Xi Jinping said it's one of his top priorities in his agenda is the reunification of Taiwan back with the mainland. So that's still a wild card that is yet to play out. But once again, it's why we diversify. Don't put all your eggs in one basket. I only have a small portion of my portfolio in Chinese related shares, and I'm also leaning towards companies that serve the Chinese market, in addition to other Southeast Asian markets as well. Companies coming out of Singapore, I think, are a bit more insulated from what could happen in China in this scenario. But either way, for the here and now, global liquidity just got a massive boost coming out of the second largest economy in the world. And like hedge fund manager Eric Jackson says, we could be in for an everything rally. Stocks are mirroring the early days of one of the history's biggest bull market, comparing the current economic environment to the 1982 bull market, when rates dropped and the economy grew. With them going on to say interest rate cuts, economic growth, and the yield curve changes favor risk asset. We also got Fundstrap's Tom Lee saying there's 3 things that point to a strong stock market rally through December, even as election uncertainty looms. He cites declining margin debt and a dovish Fed as key reasons to be bullish on stocks. Going on to say we really haven't seen tops until margin debt actually starts to really roll over. And that's one thing that's different between now and 2007, in which we had a very similar setup to what we've got today. Is back then, margin debt was through the roof, and household debt as well in real estate. Consumers were levered to the gills, big blow up in the subprime mortgage market. That caused a huge deleveraging felt around the world. Also, what we've got different these days, companies are cashed up and they're buying back their own shares. On track again for another record year, head and shoulders above everything else we've ever seen. Amount of corporate buyback, very supportive of stock prices. And even though the semi-chip AI trade has been getting tested these last few months, still appears to be alive. Just got results from Micron today, getting a good market reaction on robust AI demand. Revenue coming in above expectations, along with earnings per share, and they contribute 93% of their revenue growth to robust AI demand. They lead in DRAM, flash memory, and key supplier of HBM for AI servers. And there's a look at the daily chart on Micron. Clear signs of accumulation and ripping up after hours as I speak, just going down to a 5-minute chart. We're up 14.2%. Pretty big move for this key semi. No doubt analysts will upgrade them tomorrow. And this had been one of the weaker semi stocks of late. And that's helping to get Nvidia trading up after hours as I speak. Currently at 124.50. It too may take another stab at all-time highs, along with some very bullish seasonality over the next few weeks and few months coming into the stock. Also got Tesla trading higher, but it too may be a little technically overbought in the short term. We've got deliveries coming on the 3rd of October, then a week later, robotaxi event. Any dips in Tesla may get bought and we could still be trading $300 a share come the robotaxi event, 10th of October. We also heard Meta unveil a new and really well-priced $299 Quest 3S VR headset with Orion AR glasses prototype, with the Zuck looking to go mainstream with this product and own the digital land of what could be the next big tech product. Even though the technology's kind of been around for a while now, virtual reality in the metaverse. He doesn't want to build on top of Apple's Vision Pro. He's already learnt that from having to operate his apps within iPhone. Apple has leverage over him. So in addition to his new perm and going for the cool guy look from a years-long nerd identity, he appears to be going all in on VR as well. And that price is something that can be adopted mainstream. However, there's still a lot of hurdles, just like we've seen with Vision Pro. What it does to people's eyes, their brain, their neck, and just mentally and socially as well. Imagine we're getting kids spending more time in virtual reality than actual reality. What does that do to the mindset? However, that hasn't really stopped Zuck in the past. We've seen the rise of a lot of mental diseases, along with social media and Instagram. He'll keep sending you a dozen push notifications every day, try and reel you back into his apps, and I'd say he's got a pretty good chance at doing this with VR and the metaverse as well. And Meta is sitting at all-time highs, but it too looking a little short-term toppy here. And the verdict's still out on Apple's new iPhone 16. Some saying it's doing better, others say it's not. China's soft, some saying there's less pre-orders, others say lack of innovation. They're just integrating basically ChatGPT into their phone. But that's kind of the thing, isn't it? Apple's so big and dominant, over 1 billion customers around the world, they don't even really need to innovate. It's going to be so hard for someone to knock them off their perch. They just pretty much integrate technology's already out there, package it with an Apple logo, and then charge a really hefty premium price for it. It's been working for a long time. No doubt it's going to continue working for a long more time. However, the market's pretty much traded flat since we've seen the release of the iPhone 16. Still the largest stock in the market though, just below 3.5 trillion market cap. But who knows, maybe going into the holiday spending Christmas period, we see those iPhone 16 orders ramp up along with the stock price. And so we've seen a huge influx into bond funds this year. Probably part of the reason why the 2 years dived so much. Everybody and their dogs just jumped into short-term bonds. No one really wants to own long-dated bonds and lend to the US government for 10, 20 years. In fact, bond ETF flows this year just topped an annual record set in 2021. Bond market on track for 5th straight month of gains in September. Over 215 billion has gone into US bond ETFs this year on big anticipation of Fed rate cuts. We've got the BlackRock chief investment officer actually saying it's a golden age of fixed income. That stocks can still do well, but the compensation for taking equity risk is near the lowest in 20 years. But I'd say that's already been largely got. Looking at the 2 year at 356, I mean, we got Fed funds at 475. A lot of the market's just pricing inflation to come down and no recession. And typically a rate cutting cycle is only around 150, 200 basis points. We started at 525. That means on average, we're supposed to get down to 375, maybe 350, 325. So the bond market may have already front run the majority of this entire easing cycle, and yields just may chop around 340 to 380 for some time yet. And like I said, it's only really the Fed funds rate that's kind of indicating we may get a recession here at 97%. Looking at mortgage-backed securities, cyclicals versus defensives, high yield spread, the VIX, and other measures, the market's not really pricing in a recession here. And this could be the Fed funds rate just pricing in inflation dropping like a stone. However, if we don't get a recession and inflation comes down, that could just be too much of a good thing. And then spending, investment, everything shoots up again and causes inflation, because the only really way we're going to get inflation down is a recession. Economy has to contract for prices to come down. And we'll get another look at that this Friday. PCE expected to come in 2.7% year over year. I'll be very surprised if that came in hotter. What's going on now will take at least a few months to filter through markets in the economy. And that's why if we are going to see an uptick in inflation, it probably is not going to come until Q1 or Q2 next year. Moving on to commodities, we've got oil, still not getting big action. Didn't get as excited over China's stimulus like others like copper did, and trading really heavy the last few months. Not even everything that's going on around the world has been enough to spike it, and that's because we've got huge amount of supply, among other things, sending the price of crude back down under $70 a barrel. And there's a look at copper after its big rip yesterday, just kind of catching its breath here too, along with silver. However, we've still got agricultural commodities now ticking back up close to 52-week high. And so once again, there aren't many articles across mainstream financial media to do with gold, the dollar, and Bitcoin. However, I did find one today on MarketWatch, and this is it right here. Why now may be a good time to take profits in gold and silver. And so we've got an article today, but the sentiment and tone is bearish, making a case for why both metals may decline soon, saying all the gains on the upside have been exhausted. There's technical reasons. October's been historically a weak month, but didn't really speak to anything about the fundamentals of what's driving gold higher. And for sure, it is a little technically stretched in the short term. Like I just said earlier, my reversal signals are firing off. Bit of bearish seasonality in the next week or two. However, that doesn't mean I would short it here. And the fundamentals and medium long-term trends are still well intact. And that's thanks to the heavy US dollar of late, which is still trying to hold this big support zone around 100. And there's a look at Bitcoin. It too just kind of pausing, but it also has a lot of bullish seasonality coming in over the next 1, 2, 3 months. And the big fundamental driver of gold is that it's priced in US dollars. And what weakens a country's currency, and this has held true for thousands of years, when a country spends like crazy, borrows like crazy, they create a huge amount of debt, which also creates a huge amount of inflation. And simple supply and demand will tell you, when supply goes up a lot, but demand stays relatively the same, well then the value of that currency will come down. And so from 1966 to 2023, debt in the States grew 100-fold. Now the price of gold's only risen 50-fold. And so wouldn't it be crazy if gold's still actually undervalued here and can actually trade well above the rate of advance of US debt like it did in the late 1970s, early 1980s. And this bull market in gold takes it to over $10,000 an ounce before it has a sizable correction. And I just got another green light for another commodity I'm bullish on, uranium and nuclear power. With it being reported today that Microsoft wants nuclear power so bad for AI that it's paying double. That's at least twice the going electricity rate to ensure it can get power from a nuclear reactor for the next 20 years. The price tag shows just how much big tech firms are willing to spend to secure enough capacity to power the massive data centers they're using to run artificial intelligence applications. So that's a good sign. A big cashed up buyer like Microsoft lifting the offer on what they're willing to pay to get into nuclear. That's a really good sign for us. And there's the Global X Uranium ETF today, also sitting pretty at recent monthly highs. Something that's not good for inflation here and now is a dock worker strike in America's East Coast shipping ports, in which some 85,000 dock workers will strike coast-wide from the 1st of October if there's no new agreement on a new 6-year labor contract to replace the existing one that expires on the end of this month. In the event of a strike, diverting vessels to West Coast ports is not an option. Could be a big potential stoppage and bottlenecks. And there's a look at the global shipping ETF boat. Has been trading up the last few weeks as well. And speaking of transportation, an interesting post on X showed up in my feed today from the current Secretary of Transportation, Pete Buttigieg, in which he claims, sure is interesting how we passed the Inflation Reduction Act and then inflation went down, which is kind of crazy to hear a top government official make that claim. Maybe he's trying to fool the layman into thinking they've got inflation down from their Inflation Reduction Act, which was actually signed in 2022, with the main objective to reduce the federal government deficit. That's the difference between what they spend and what they earn, as they know that's a big key driver of inflation. However, when you look at the actual data of when the Inflation Reduction Act was signed in 2022, federal deficit was 1.3 trillion, actually went up in 2023 to 1.7 trillion, and we're currently tracking at 1.9 trillion, with government spending, deficits and debt almost going vertical in this last couple of years. And so what I think he's trying to fool people into thinking is that even though the pace of inflation growth is slowing, inflation's no longer going up 8-9% a year. It's apparently going up 2.7% a year. I think what Pete's missing out on is the structural embedded inflation that people feel every day when they go and buy their food. You can also thank him for only managing to build 8 electric vehicle charging stations with a $7.5 billion investment. The Federal Highway Administration says only 7 or 8 charging stations have been produced with a $7.5 billion investment that taxpayers made in 2021. And again, just another example of how poor governments, not just this US government, but all governments around the world, when they become too big and bloated, things just get messy, they get inefficient. And you can imagine this was handed to Tesla to take care of. They probably would have bound to do 1,000 in that time. Because in the private sector, if things don't get done, people lose money, people lose their jobs. But what happens when these guys don't get it done? Well, they just come onto X with some word salad to try and convince people that they really did get it done. And in fact, potentially the next president of the United States. This is the person that apparently is going to stand up to Xi Jinping and Vladimir Putin and help set the world straight for us all. Said yesterday it will be her day one priority to bring down prices, take on big corporations, and cap the cost of prescription drugs for all Americans. She believes everybody in America should have the chance not just to get by, but to get ahead. So somebody should let her know. Her and the old man have been running the country for the last 4 years. Why doesn't she just do these things already? Why can't we get prices down now? And didn't the Secretary of Transportation just tell us that they've already got inflation down? But maybe their attention is elsewhere. Here's potentially the next Vice President of the States making his second visit in recent times to Alex Soros, the son of George Soros, who've been criticized of funding a lot of the riots we've seen in America over the past 5-6 years. Now, I don't know about you, but he looks pretty submissive there to me. But whilst all that's happening, we're still getting big threats from Russia and Putin. Is he still bluffing? Is that the strategy we're all going to stick to going forward? Hoping Putin keeps bluffing, saying that if he's attacked, he might just send back a few nukes. In which we're already getting news that NATO is preparing for a huge number of casualties in case of World War III. Scenario with Russia, as the German military says an invasion could happen this decade. NATO's top logistics chief said the bloc must be prepared for mass casualty. Now, I don't know about you guys, and for all my viewers under the age of 50 in Europe, who knows, other countries of the world, are you willing to go fight this war? Is defending Ukraine's border so important to us that we're willing to risk it all? Should NATO keep advancing closer and closer to Russia? Or is it the industrial military complex lobbyists that have helped to form this policy and NATO creep closer and closer to Russia, knowing that just leads to the continued flow of weapons and money into their back pocket? While they have no problem sending young people there to die, of course not their own sons, right? But of course a lot depends on what happens in November. War could very well be negotiated away, which it appears some deep-seated interest really don't want to see, and that's why, in my opinion, it's been escalated right at this point of time. Anyway, we'll see what happens there. Moving on to a lighter story to finish up today's news. Japan's got its largest rice shortage in years. That's exacerbated by sushi-hungry tourists. They've been contending with a rice shortage in recent months due to a mix of bad weather and increase in tourists. Like I said a few months back, when the yen was super cheap, it's a great time to travel to Japan. If you're big into sushi like I am, appears a lot of people have done that. The Japan rice economy remains largely isolated from the world market. It was actually the Japanese rice market and rice traders back in the 1600s that created technical analysis. They created candlesticks to chart the daily price movements of rice. A lot of good technical analysis comes out of Japan. So we've got at least that to thank them for. Moving on to the economic calendar. Wasn't much out today. New home sales down month over month. Tomorrow, GDP growth rate, revisions for Q3, expected to come in 3%. Durable goods orders, jobless claims, heaps of Fed speakers. And like I said, Jay Powell, 10 minutes before market open. Maybe the market will be looking for hints whether he's going to do another 50 basis point cut. And if so, that could get things moving again. Then the big one, core PCE, Friday, 2.7% year over year expected. And it's incredible. The market, Fed fund futures still pricing in another 50 basis point cut come November, with apparently inflation and or the economy set to fall off a cliff soon. And that's a wrap for today, guys. Thanks very much for tuning in to Click Capital, and I look forward to seeing you back here again the same time tomorrow. Cheers.